What's up guys, it's Michael here. In this video, we are going to cover how cryptocurrency and taxes work. So I invited a tax expert over to explain how do taxes affect cryptocurrency. A lot of people think that blockchain itself cannot be taxed, but if you take money out and use it as investment, you are going to get taxed. If you start spending money you made from cryptocurrency, you are going to get taxed. So instead of fighting against the law, why don't you just work with the law? Because at the end, cryptocurrency is an investment. And here's an in-depth guide on how does it work. If you have more questions, please comment down below, like and subscribe, so I can get people like this, tax experts, who come on this channel and explain how do these things work and how can you fill out forms so you basically be in compliance with the law. Let's begin.
Let's talk about cryptocurrency and taxes. What is cryptocurrency and how cryptocurrency transaction is reported for income tax purpose? Cryptocurrency is a virtual money. It is a digital representation of value that is neither issued by a central bank or a public authority, nor necessarily attached to a fiat currency. It is issued by its developers and used within a given virtual community. Cryptocurrency is accepted by natural or legal persons as means of payment and can be transferred, stored, or traded electronically. Therefore, it's taxable. It operates like a currency in some environment but does not have all the attributes of real currency. In particular, cryptocurrency does not have legal tender status in any jurisdiction. However, it's taxable. The IRS defined cryptocurrency as a property, not a currency. Therefore, for federal income tax purpose, cryptocurrency is treated as property. Tax rule applicable to property transaction also apply to transaction using cryptocurrency. For example, you use cryptocurrency to exchange for goods and service. Those are taxable, and the tax rule also apply to them. Cryptocurrency cannot be reported as currency transaction, and no foreign currency gain or loss can be claimed on the U.S. income tax return. It has to be claimed as a property gain or loss from property transaction on the tax filing. So what is considered as taxable events related to cryptocurrency? Basically, every crypto you swap, exchange, sell, convert, earn, or mine, rewards you receive, those are all taxable in the year that you receive. The value you pick up on any of these events is taxable. But how do you determine the value? It's a fair market value. So it have to be measured in the US dollar as of the day the crypto was received or provided to you. For example, the basis of a cryptocurrency that a taxpayer receives as a payment for goods or service is the fair market value. How do you determine that? And you are required to determine that, by the way. If a cryptocurrency is listed on an exchange and the exchange rate is established by market supplies and demand, the fair market value of the cryptocurrency is determined by converting the cryptocurrency into US dollars. Or into other real currency, which in turn can be converted into US dollars at the exchange rate. The method you convert that need to be consistent, so you cannot use a method differently from day to day or year to year. So how should it be reported? So first of all, we'll talk about determine the fair market value. This what will be your basis of the income on the basis of the cryptocurrency. For you keep it as investment. So the character of the income, right? First of all, you probably would not receive a 1099-B like you normally receive when you invest in stock market. So therefore, you need to keep a good record to show the cost, the basis, the time when you receive the currency. And the character of the income, it really based on the activity, how you receive that and what you receive that cryptocurrency for. Is for service, for goods, from investment. That would determine the character of the income. Is that a capital income or loss, or this a self-employment income or other income? If that is the exchange for services, that is your compensation. It's a self-employment income likely. If you keep that cryptocurrency you earn or you mine or you however you got it, and later on you exchange that for goods or exchange for other currency or exchange for money, the real currency, that will be considered as capital income. Depends on the holding period and can be short-term or long-term. For example, I can give a quick example. For people who provide service, some of the employer, they probably, instead giving you money, they give you cryptocurrency. So does that need to be reported? Yes. That is considered wages. The cryptocurrency reported have to be taxed for Social Security or for other withholding tax requirement. And the value of the compensation will be the fair market value that cryptocurrency was given to the employee or the person who provided services. So another example is that if you earn cryptocurrency through service, so when you receive that cryptocurrency, you're going to have wages income or self-employment income. So when you keep that cryptocurrency for a period of time, and then you exchange that later on for other goods, other service, at that time, that cryptocurrency, the difference in the basis is going to be your capital gain and loss. So that is the nature of the income is going to change. Therefore, keep a good record on the value, timing, and other details of the transaction to support the gain and loss claim on your tax return is really important. That can impact the cost basis of the crypto and the holding period of the investment in terms there's an audit. This is very general. There's a very general discussion of cryptocurrency taxation. So please consult with your tax advisor.